Get with the flow. This is the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. And joining me today is Paula Young, a partner at EisnerAmper. She's also an NJCPA trustee, a member of the Education Foundation Executive Committee, and an active member and past leader of the Accounting and Auditing Standards Interest Group. Welcome, Paula.
Thanks for having me.
Are you guys trying to interview my replacement here? I don't know. I've got a lot of great guests lately.
No replacement for you.
Thanks. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. Quick disclaimer, the views and statement expressed herein are our own and not necessarily those of NJCPA, CLA, or EisnerAmper. We got all that out of the way. So the topic, the topic today, I tried to come up with something new, so I went all the way back to 1988 when I graduated college. I know I'm old, okay?
Me too.
And my professor actually had to change the textbook or not reference what was in the textbook because it was a statement of changes in financial condition.
Yep, I learned that too.
Well, I didn't want you to say that. Okay.
I did. It was what was in the textbook.
I was hoping you were saying ASU 1. Okay. And they came out with FAS 95, which was a statement of cash flows. And it was a massive change that they came out with.
Yeah.
And since then, there have been a lot of other ASUs that have come out, clarifying certain things, which we know from the FASB, that's what they do, is they just constantly bring something out and then they keep changing and modify it. Because I think since derivatives came out, there's been 25 different ASUs. But it was a significant change to the financial reporting model and components. In there, though, they had they required or recommended the direct method of statement of cash flows. But they gave the people the out called the indirect method.
Right.
And
everyone took the out.
Yeah, everybody takes the out. We actually, in our office, we actually have to do, not a good amount, but we do a bunch of direct method for certain HUD clients. It's required. But do you see a lot of people doing the direct method at all?
I think I've had one in my entire career so far. And it was the client preferred it. But other than that, no, it's almost exclusively indirect.
And I've heard that they're saying that they want to go back to it.
They do. They feel that it's more useful information to the users of the financial statements, but they haven't really gotten the buy-in from the preparers of the financial statements and the auditors in that it's worth the effort of putting it together. Yeah,
real quick, I'm really summarizing the difference here. The indirect method simply takes the change in the balance sheet, and the operating section just has those changes. If there's something significant, that'll be addressed. But the direct method addresses receipts from customers, payments to vendors, goes into much more detail, and is much harder to prepare. So I think that's why you probably said, they're not getting the support of the preparers.
Right.
Right. So the direct method is most popular. There are three main sections that are included in the statement of cash flows. You have the operating section, you have the financing section, and the investing section. Now, I know we're going to cover common issues. One issue I'm just going to touch on, you'll probably mention it more, is people putting things into wrong sections.
Yeah. There's a lot of judgment involved in deciding where it belongs, whether it's an operating activity, an investing activity, and that significant judgment causes, errors, frequent errors to happen because there is so much judgment sometimes.
What I see people drag on when I'm watching the staff trying to prepare the statement of cash flows is they try and attack it in whole, and I know some people hate cash flow worksheets, but the thing I like about it is because especially with just a change in the balance sheet, it puts things into the different buckets pretty easily and then allows them to focus on the important things. Otherwise, they will sit there for a half hour trying to figure out what's allowance for doubtful accounts versus or bad debts and on cash operating versus changing AR, and they'll spend a half hour just on that.
Right.
Get the mathematics done, and then let's focus on the details. There is supplementary information. That supplementary information is for indirect method is income taxes paid,
Yep.
interest paid.
Yep.
Now I know with the they're addressing now, and I think an ASU came out for relating to income taxes, discussing the refunds too. But income taxes paid, interest paid, and then significant non-cash items,
Right.
Cash financing, investing. Those are the ones I see a lot. I'm sure you've seen some other, and you do SEC work too, right?
I do, yeah. And I think one of the new ones that have come out because of the lease standard. Everybody's
Yep.
adopted the lease standard now, and there are additional disclosures in the cash flow that relate to the lease standard. And there's significant non-cash disclosures too, especially on implementation or entering into a new lease. It can be a very material non-cash disclosure that needs
Sure.
to be there. So that's kind of new, that people may forget that that the lease standard has required some additional cash flow disclosures.
I write myself a note to go look at that in my financial later. But nobody, and the other thing is in the operating section, as you mentioned the leases, nobody knows how to figure out that disclosure. It's just in the operating section.
Yeah, there was some inconsistency when the lease was first adopted for public companies as to where it went in the cash flow. So people kind of put it in different places. And I think it's kind of come to more of a consensus now as to where it should be. In the statement of, or in the operating activity section, but it took a little while. That was, I think, it was one of my biggest questions when we adopted the lease standard for the public companies, because the Big Four have their guides out there on adoption of the standard, and there was inconsistency between the guides as to how as to how to present it. So, but I think that it's kind of come to a consistent now.
I appreciate that recommendation about the Big Four, because the Big Four all put out guides, and they do make them available to the public.
They are. Yep, they're out there for everyone.
And I've called the IssuesCPA technical hotline, and when I talked to the IssuesCPA, even they've said, well, we're looking at the PwC guide, or we're looking at this, and I'm like, that's not authoritative, by the way.
Yeah.
But they use it. It's a great reference tool. I recommend.
There's some great examples.
Yep.
It's easy to read. In addition to the standard, you got to read the standard as well.
Exactly.
But yeah, they're very helpful.
Last thing I just mentioned, one of the big changes was around 3 or 4 years ago and became effective was the restricted cash. Restricted cash is required to be part of the cash balance.
Yep.
We
have to reconcile that to the balance sheet. Yep.
Exactly. We have an issue with it because, particularly with the HUDs that I mentioned, they don't want it in there. Yeah, so it becomes very difficult. But so we make disclosure saying that it's not in there. At the end, the reader's informed. That's the important thing. What common issues do you see? I know that you've reviewed and you're in the national end of your firm. But what common issues do you see when you look over cash flows?
I'd say it's the statement that I find the most errors in when I review financial statements. It is, and it's and I've always said it's my favorite financial statement. If somebody's going to have a favorite, the cash flow has always been my favorite financial statement, because as a reader, I feel like I get the most information out of that statement. Like when I look at that, I really, especially as a national office reviewer, I read lots of financial statements, and I read them cold, without having done the audit or the accounting, and I get the most information about the client from reading that statement as to what happened during the year. And so I find the most errors in that. I find a lot of errors in non-cash, not disclosing non-cash transactions, and then obviously also the classification. Yep. Whether it's an investing or an operating activity or financing, there's a lot of misclassification. And one of the core things with the statement of cash flows is things are supposed to be shown gross, and I see a lot of inappropriately netting of certain balances or transactions in the statement of cash flow where they should be showing it on a gross basis, because that's how you give the reader more information, instead of netting two numbers, like a loan, netting principal repayments and borrowings. Most of the time you can't net those, and I see that error happening a lot.
I see that a lot. The leases, even one of the guys, PwC, or the guy says there's not enough clarity on this if you should be netting or separating the change in the asset and the liability.
Right.
The one thing I love, one of the common issues I've seen, dividends, where do they go? Dividends and distributions. I mean, it's an investment, right? That's what I see all the time. Well, I invested in the company. No, you in essence finance the company. I know that it's capital, But I've so often I will see, especially younger staff, putting distributions or dividends into investing rather than in financing section.
Yeah. Yeah. Classification.
Yeah, classification. The other classification I see a lot is the loan costs, debt issuance costs. I'll see that in operating too.
Or they net it.
Oh, I forgot about that. Yeah.
They don't disclose it as a separate line item in the cash flow. They put it with the principal repayments or things like that.
And one of the things I'm actually having one of the harder times with is the debt issuance cost, the amortization. You know, because it's included in interest.
Yep.
But it's amortization. It can get complex. To your point, you had made a comment one time, and I knew what it was because I dealt with it. Big R and little r.
Yeah. Like I said, there's a lot of errors. I find a lot of errors in financial statements, but the SEC has also said that cash flow errors is one of their most frequent errors or restatements that they come up with. And what they found is that when companies are doing their assessment of the materiality of an error that was identified, a lot of times they're making the conclusion that that error was not material. So they're not going back and restating a prior period, which would be a big R. They're doing it as a little r, where they would just record that adjustment in the current period instead of bringing it back to the period it relates to. And that's because, I guess, a misconception amongst people as to what's a material error in a cash flow, because they think that if they've incorrectly classified, like they put something in investing and it should have been a financing activity, that it's just a reclassification and therefore it doesn't matter and it's not material. But what the SEC said, and what I think is the right answer, is that classification in a cash flow is the point of the cash flow. Like, it's understanding what kind of activity it is. So the fact that it was incorrectly classified is material.
Right.
And you can't just say, oh, it's just classification. So we don't have to worry about going back and doing the restatement. So they want people to really consider materiality when it comes to classification errors in a cash flow.
The readers are making decisions based on, in essence, the totals: total operating, total financing, total investing. And if you move between there, it could affect their decisions.
Yeah.
I'm reading that financial. All right. Anything big that you see coming on the horizon?
There is a FASB project that they have put out there. I guess it was just back in November they put it out. It's something they added to the technical agenda, and it's a target improvement to the statement of cash flows, and it relates to reorganizing and disaggregating the statement of cash flows for financial institutions. So that's something they just recently added to their agenda. So it's pretty targeted, but that may be coming out.
No moss grows on this stone. A few closing notes. Registration is open for the NJCPA Convention and Expo taking place June 11th to the 14th in Atlantic City. Get the details and register at njcpa.org/convention. For news, articles, and events on all accounting and auditing topics, visit the NJCPA A&A Knowledge Hub at njcpa.org/hub/accounting. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group, right?
Great group.
Yeah, sign up for free at njcpa.org/groups. Paula, thank you very much for enduring me during this session.
Thanks for having me.
And you know what?
Always enjoy having conversations with you.
I always have to show guests the arms. Look at them.